Have you ever stopped to think about what it means when a country owes more money than the entire value of everything it produces in a year? That is the situation the United States is currently facing. The national debt has now passed $38 trillion, an amount that is difficult to even imagine. To give a sense of scale, counting $1 every second would take more than a million years just to reach 1 trillion. And the country now owes 38 times that amount. On top of that, the debt is still rising. The government is adding roughly $2.4 trillion per year, which works out to about $200 billion a month, $46 billion a week, or $6.5 billion every day. This isn't just a big number on a government spreadsheet. Debt affects everyday life, shaping inflation, interest rates, taxes, government programs, and the overall buying power of the dollar. The larger the debt becomes, the harder it is for the country to invest in long-term growth and opportunities, such as transportation, schools, and scientific research. No one expects the US to pay off $38 trillion immediately. National finances don't work the same way as household finances. The concern is that the government continues to spend far more than it earns each year, adding new debt without a realistic plan to reduce it. It's the economic equivalent of using a credit card indefinitely, while making payments that don't cover the balance. This brings us to the question everyone is asking: what happens next? One of Donald Trump's main economic proposals involves placing large tariffs on goods imported from countries such as China, Mexico, Canada, and many European nations. He has said that the money collected from tariffs could be used to help pay down the debt, and that each American family could receive a $2,000 tariff dividend. However, even under extremely aggressive tariff scenarios, the government would likely collect no more than about $500 billion a year. While that is a large amount, it falls far short of the current $2.4 trillion annual deficit. In other words, even with maximum tariff revenue, the government would still be short by nearly $2 trillion per year, meaning the debt would continue to grow rather than shrink. Despite these concerns, the stock market remains very optimistic. The S&P 500 recently reached record highs near 6,640, and major investment banks expect it to rise further. Barclays has projected 7,400 by the end of 2026. Morgan Stanley sees it reaching around 7,800, and UBS is also confident. Much of this optimism comes from the belief that a Trump presidency would reduce business regulations, lower corporate taxes, and significantly boost company profits. Whether that optimism is well-founded or misplaced will depend on how policies actually unfold and how the economy reacts to them. For now, financial markets are assuming everything will go smoothly. The challenge is that economic risks are rising at the same time confidence is reaching its highest level. The real story going forward will not be the size of the national debt today, but how the country responds to it in the years to come. Bitcoin is trading around $97,000 and heading toward $100,000. Gold has climbed to about $4,500 per ounce. Many investors are celebrating, but a small group believes these price jumps are actually warning signs. Most people think Trump's tariff plan and business-friendly policies will solve the country's financial problems. According to this viewpoint, they won't. In fact, the argument is that the years 2026 and 2027 will bring the worst economic crash since 1929, with the S&P 500 falling from around 6,600 to below 3,400, Bitcoin dropping from near 100,000 to under 20,000, the US dollar losing its status as the world's main currency, and the country facing a historic debt crisis. This isn't about politics, it's about math. And the math is troubling. The national debt is currently about $38 trillion, while the US economy produces about $28 trillion in goods and services each year. That means the debt is roughly 136% of the size of the entire economy, the highest level in American history, except immediately after World War II. But there's a major difference. After World War II, the United States had a booming manufacturing sector, a young and growing population, and extremely low interest rates. Today, none of those advantages exist, which is why this argument claims the financial situation is much more dangerous now. Over the last 30 years, the United States reduced its debt mostly by growing the economy. That worked when factories were still here, the population was younger, and interest rates were close to zero. But today, things are very different. Much of American manufacturing has disappeared, the population is aging, and millions of baby boomers are retiring. At the same time, interest rates are around 5%, not near zero like before. In the 2024 fiscal year alone, the US government paid more than $1 trillion just in interest on the national debt. That amount is higher than what the country spends on the military or Medicare. In fact, it is now the second largest expense in the federal budget after Social Security, and it continues to rise. The problem is that the government spends far more than it collects in taxes. Each year, it borrows about $2.4 trillion to cover the gap, which is known as the deficit. Because of this, the national debt is expected to increase from $38 trillion today to $40.4 trillion in 2026, then to $42.8 trillion in 2027. By the year 2030, the debt is projected to reach $50 trillion. By then, yearly interest payments may climb to about $1.5 trillion, which would mean that around 20% of all tax money would go only toward interest, not toward defense, infrastructure, education, or anything that benefits the public. It would simply go to paying bondholders. This creates a dangerous cycle that becomes harder and harder to escape. There are only 3 possible ways out, and none of them are good. One option is to grow the economy faster than the debt is growing, but tariffs, like the ones proposed by Donald Trump, would slow economic growth, not boost it. Another option is to allow high inflation by printing money, which would reduce the real value of the debt, but also weaken the dollar and make everyday life more expensive for everyone. The final option is to refuse to pay the debt, which would cause a collapse in the global financial system, because US government bonds are the world's most trusted financial foundation. Trump has said that tariffs could pay down the debt, but the numbers do not support this claim. The United States imports about $3.4 trillion in goods every year. Trump has suggested a 60% tariff on goods from China, which sends about $500 billion in exports to the US. He has also mentioned a 25% tariff on goods from Mexico and Canada, which together account for about $800 billion in imports. In addition, he has talked about adding a 10% to 20% tariff on nearly all other imports. Even if all of these taxes were imposed, the total revenue from tariffs would be about $710 billion a year. That may sound large, but it is far from enough to solve the issue because the annual deficit is around $2.4 trillion. In other words, tariffs would cover less than 1/3 of the shortfall, and the rest of the debt would continue to grow. Tariffs do not reduce the national debt, and they do not even make a meaningful difference in slowing its growth. The situation is actually worse than it appears because tariffs are not free money. They are taxes on imported goods, and American businesses are the ones who pay them. These businesses then have 2 options: raise prices for consumers or accept lower profits. When tariffs make products more expensive, people buy less, and companies often shift their supply chains to other countries, to avoid the higher costs. As a result, the amount of money collected from tariffs is always much lower than the maximum theoretical amount. Most economists estimate that the US would bring in around $400 to $500 billion a year from tariffs, not $700 billion. This estimate doesn't even account for retaliation from other countries. If the United States raises tariffs on China, China responds by raising tariffs on American products. Farmers suddenly can't sell soybeans overseas. Manufacturers lose buyers for their machinery. Tech companies struggle to sell their software abroad. Exports decline, the economy slows, tax revenues shrink, and the expected benefit to the federal budget becomes tiny or even negative. On top of this, Donald Trump has promised what he calls a tariff dividend, meaning he wants to send $2,000 per year to every American household. There are roughly 130 million households in the country, so this program would cost about $260 billion each year. If realistic tariff revenue brings in $400 to $500 billion annually, and $260 billion is paid right back to the public, only $140 to $240 billion would be left to reduce the deficit. That amount covers just 6% to 10% of the current $2.4 trillion yearly deficit. In other words, it hardly makes a difference. Meanwhile, tariffs trigger inflation because they raise the price of imported goods. Prices go up, economic growth slows, and the Federal Reserve cannot lower interest rates to support the economy, because inflation would rise even further. The result is a recession, which causes tax revenues to fall sharply and the deficit to get even bigger, possibly reaching $3 trillion or more per year. In short, tariffs do not fix the debt problem. They make it much worse. This is why economists across the political spectrum warn that the plan is unrealistic and dangerous. Despite this, Donald Trump dismisses economic experts and insists he knows better. For the moment, financial markets appear to believe him. Wall Street is extremely optimistic, and the stock market continues to reach record highs. The S&P 500 cites at 6,640, a new all-time record. Barclays recently raised its forecast for the end of 2026 to 7,400, predicting an 11% increase from current levels. Morgan Stanley is even considering scenarios that could take the market near 7,800. UBS also remains optimistic, with some caution. Meanwhile, Bitcoin has surged to $85,000 and looks ready to cross $100,000. Investors are betting on Trump for three key reasons. Investors are excited because they believe three things will happen if Trump returns to office. First, they expect a cut in corporate taxes. Trump has said he wants to lower the corporate tax rate from 21% to 15%, which would instantly raise business profits by about 10%. Higher profits generally push stock prices higher. Second, they expect fewer regulations. Looser environmental rules, weaker labor protections, and less oversight of large companies would reduce costs and increase profit margins. Third, confidence among business leaders is rising. CEOs are planning to spend more, corporate stock buybacks are increasing, and optimism is spreading across the market. When optimism is high, the stock market tends to rise because investors believe good times will continue. However, these positive predictions all come with major warnings that are easy to overlook. Barclays says the S&P 500 could reach 7,400, but only if there is no recession, if policies are rolled out smoothly, and if borrowing conditions remain strong. Their worst-case scenario, where tariffs trigger a recession, sends the market down to 4,500, a collapse of about 32% from current levels. Morgan Stanley cautions that the middle of Trump's term could bring policy setbacks, unexpected problems with growth or inflation, and market instability. UBS notes that stock valuations are already unusually high for this stage of the economic cycle. When valuations are stretched, even small disappointments can lead to large market drops. None of these opinions are unconditional confidence. They are bets that everything will go perfectly, and history shows that almost nothing ever plays out perfectly. Independent analysts outside the big banks are sounding even louder alarms. They argue that Trump's economic plan would create stagflation, a mix of high inflation and low growth. Tariffs would push prices up, global trade tensions would slow the economy, and the Federal Reserve would be stuck. Cutting interest rates would fuel more inflation, but raising rates would make a recession worse. In that scenario, both stocks and bonds fall at the same time, leaving very few safe investment options besides cash and gold. Some analysts estimate the odds of a major financial crash in 2026 or 2027 at 30% or higher. That is not a remote risk. It is a significant chance of a serious crisis. Meanwhile, the stock market is behaving as if everything will go exactly right. With the S&P 500 at 6,600, investors are assuming tax cuts pass, tariffs stay small, economic growth remains strong, inflation stays low, the Federal Reserve reduces interest rates, and corporate earnings grow 15%. None of these outcomes are guaranteed. Many are unlikely, and the failure of even one assumption could trigger a sharp downturn. If the situation unravels, it would likely follow a familiar pattern seen in previous financial bubbles. At the start of 2026, Trump enters office and announces major tariffs on China, Mexico, and Canada. At first, the markets respond positively because investors focus on potential tax cuts and deregulation. The S&P rises to around 7,200, and Bitcoin jumps above $100,000 and reaches about $120,000. People become extremely confident. Television networks talk about a new era in investing, and everyday investors rush to buy because they are afraid of missing out. But behind the scenes, professional investors begin selling quietly. Corporate insiders who own shares start cashing out. Volatility stays low temporarily, giving the illusion that everything is safe and stable, even though risk is building. At the start of the downturn, the market still looks calm on the surface. The VIX, a measure of expected market volatility, sits at very low levels, and investors convince themselves that nothing can go wrong. People feel safe, unaware that danger is approaching. From April to June 2026, the shift becomes impossible to ignore. China strikes back with tariffs of its own, targeting major U.S. industries such as farming and manufacturing. Soybeans, corn, airplanes from Boeing, and products from Apple all get hit. At the same time, the Treasury Secretary warns that foreign demand for U.S. government debt is slowing. China begins selling off its holdings of U.S. Treasuries, decreasing its position from about $770 billion to $650 billion. As a result, Treasury yields spike, pushing down the prices of bonds. Pension funds and insurance companies that hold those bonds take heavy losses. Borrowing becomes more expensive across the economy. Mortgage rates return to around 7%, and companies face higher costs when they try to borrow money. First quarter earnings reveal that companies are struggling. Sales are flat or declining, while costs are rising because of tariffs. Profits fall short of expectations, and the S&P 500 drops from 7,200 to 6,200, a decline of about 14%. Investors treat it as a normal correction rather than a crisis. Bitcoin slides from $120,000 to $90,000, and technology stocks fall the hardest because they were priced the highest. Analysts tell the public that this is a chance to buy the dip, but buyers are stepping into a market that is still deteriorating. From July to September 2026, the situation worsens dramatically. A major company or regional bank reports massive losses. It might come from bad commercial real estate loans, risky foreign currency bets, or highly leveraged corporate borrowing. The specific trigger doesn't matter. What matters is the chain reaction. One major failure leads to another. Hedge funds that borrowed money to increase their returns are forced to sell everything to meet urgent demands for cash. They unload both good and bad investments because they have no choice. Automated trading systems detect the selling and accelerate it, and high-frequency traders rush to profit by getting ahead of the forced liquidations. The S&P 500 collapses from 6,200 to 5,200 in just 3 weeks, a huge drop of 16%. Bitcoin plunges from $90,000 to $55,000, losing almost 40% of its value. Market volatility skyrockets, the VIX hits 50, and trading is halted multiple times as panic spreads. The Federal Reserve meets urgently and creates programs to try to support financial markets, but it does not cut interest rates because inflation is still in the 3% to 4% range. Without rate cuts, the emergency measures have little effect, and selling continues. From October to December 2026, the damage expands across the entire economy. Third-quarter earnings are terrible. Companies report shrinking revenue, rising costs, and thinner profit margins. Forecasts for future performance in 2027 are sharply reduced. Layoffs increase, and unemployment climbs from 4% to 6%. With job security weakening, consumer confidence collapses. People stop spending money, retail sales fall, and the country moves fully into a recession. The recession becomes undeniable after 2 straight quarters of shrinking economic growth. The stock market keeps falling, with the S&P 500 dropping from 5,200 to 4,400. Another 15% decline. Bitcoin also continues its crash, sliding from $55,000 to $35,000, a drop of 36%. Gold, which briefly fell to $3,800 during the period of forced selling, rebounds to $4,100 as investors look for safer places to put their money. When the government releases the numbers for the 2026 fiscal year, the news is worse than expected. The deficit reaches $3.2 trillion, the national debt rises to $41 trillion, and yearly interest payments climb to $1.2 trillion and are still rising. Bond markets start to panic. Interest rates on 10-year US Treasury bonds hit 6%, meaning the government can only borrow money at extremely expensive levels. From January to March 2027, the situation turns into a full-scale government debt crisis. A Treasury auction, where the government sells bonds to raise money, fails to attract enough buyers at rates the government can afford. The shortage isn't huge, but it sends a clear signal. Investors are losing confidence. Foreign central banks continue selling US Treasuries. China reduces its holdings to under $500 billion. Japan, dealing with its own problems, sells another $100 billion. Saudi Arabia shifts money into euros and gold. In response, the Federal Reserve steps in and announces unlimited bond purchases, effectively printing money to stabilize the market. While this stops the bond panic temporarily, it damages the value of the dollar. The dollar index falls from 105 to 95 in a matter of weeks, a drop of about 10%. Import prices shoot upward, inflation rises to 6%, and workers' wages lose buying power. The public becomes poorer in real terms. The stock market sinks again, with the S&P falling from 4,400 to 3,800. Bitcoin drops from $35,000 to $23,000. pension funds become unstable, state budgets start to buckle, and the political climate turns explosive. President Trump's approval rating falls into the 30s. Democrats take control of the House after the 2026 midterm elections, and gridlock prevents any meaningful action from Washington. From April to June 2027, the economy hits its lowest point. The S&P 500 bottoms out at 3,400. A total decline of almost 50% from its high of 6,700. Bitcoin hits a low of around $19,000, down roughly 84% from its peak of $120,000. Unemployment rises to 9%, and the economy has shrunk by 4% over 4 quarters. This downturn becomes the worst recession since 2008, and possibly even more severe. Corporate bankruptcies accelerate. Commercial real estate continues to collapse. Regional banks fail in growing numbers, overwhelming the FDIC, which insures bank deposits. Borrowing rates surge, and only the most financially secure companies can get loans. Everyday Americans struggle to survive. Many rely on credit cards to pay basic expenses, and missed payments surge. Repossessions of cars become common. Foreclosures rise across the country. For millions of working and middle-class families, the experience feels like an economic depression. Meanwhile, the wealthiest Americans are largely unaffected. With cash on hand, they purchase discounted homes, businesses, and financial assets. The middle class, however, is devastated. Retirement savings are cut in half, home equity disappears, jobs vanish, and personal savings are drained. The financial damage described here represents a loss of wealth that will affect an entire generation. From July to December 2027, the economy begins to steady, not because conditions are good, but because the sell-off has gone so far that assets are now extremely cheap. With the S&P 500 sitting at 3,400, a price that implies a forward price-to-earnings ratio of about 14. Long-term value investors start buying again. Inflation has finally disappeared because consumer spending has collapsed, which allows the Federal Reserve to lower interest rates from 5% to 3%. This brings some relief to financial markets. The dollar stops falling and levels out at 85 on the index, still 20% lower than its peak, but no longer in freefall. The S&P slowly climbs to around 4,200 by the end of the year. Bitcoin rebounds to roughly $30,000, and gold rises to about $4,500. The economy stops shrinking, but it does not grow either. Overall GDP for 2027 is flat. Unemployment remains extremely high at around 8%, and the true number of people without work is even higher because many have stopped looking for jobs. The national debt climbs to $43 trillion, and yearly interest payments reach $1.4 trillion. About 30% of all federal tax revenue now goes just toward interest, not public services. The United States loses its AAA credit rating, dropping to AA, because many institutional investors are required to hold only the highest-rated government debt. The downgrade forces them to sell U.S. Treasuries, pushing yields even higher and continuing the financial spiral. At this point, attention turns to Bitcoin, and there is widespread misunderstanding about how it behaves during crises. With Bitcoin currently around $85,000, many enthusiasts believe it will surge to $500,000. They argue that Trump supports cryptocurrency, that the government might build a strategic Bitcoin reserve, and that friendlier regulations will increase adoption from major financial institutions. In the short term, this could drive the price higher, and Bitcoin may indeed reach around $120,000 in early 2026. However, the belief that Bitcoin will act like digital gold during a financial crash is not supported by its past behavior. Bitcoin still moves like a high-risk tech investment. When technology stocks fall, Bitcoin usually falls even harder. For example, in 2022, the S&P 500 dropped about 25%, but Bitcoin lost 65%. It behaves like a highly leveraged bet on the stock market. When the next downturn arrives, the same pattern repeats. Bitcoin first plunges from about $120,000 to around $55,000 by the third quarter of 2026, then to $23,000 by early 2027, and finally to around $19,000 at the lowest point. An overall collapse of roughly 84%. The biggest driver of this decline is leverage. Many investors trade Bitcoin using borrowed money through futures, perpetual swaps, and options. When the price drops, these investors cannot meet margin requirements and are forced to sell automatically. That selling causes even steeper losses, triggering more liquidations and a chain reaction of panic. Everyday investors who bought Bitcoin near its highs lose most or all of their money. Large institutions, which only committed a small share of their portfolios to Bitcoin, take losses but survive. The people who suffer the most are those who believed that this time would be different. Yet the same outcome occurs again, just as it did in 2018 and 2022, because the fundamental reality has not changed. Bitcoin is still an extremely volatile asset. Bitcoin has a long history of losing more than 80% of its value during major downturns, and there is no reason to expect this cycle to be any different. However, there is an unexpected development later on. Once the dollar crisis becomes clear in late 2027, and the Federal Reserve is printing huge amounts of money to stabilize the system, Bitcoin starts to look appealing again. After falling to around $19,000, it begins a slow recovery and reaches about $30,000 by the end of the year. The story surrounding Bitcoin starts to change. Not yet a form of digital gold, but possibly a long-term hedge against the weakening dollar, and perhaps a store of value that isn't controlled by any government. If Bitcoin survives and matures, it could reach $100,000 or more by 2030. But the journey to get there will be extremely painful. Anyone holding Bitcoin today at around $97,000 faces a likely drop of more than 80%. Selling now or reducing risk would make far more sense than riding the price down from $100,000 to $20,000. If someone wants to own Bitcoin long term, they will have the chance to buy again later at far lower levels. In this scenario, gold performs far better. With gold around $4,500 per ounce today, it initially drops to about $3,800 during the panic selling because investors are forced to sell everything to raise cash. But after that brief decline, gold climbs sharply as money printing accelerates and the dollar weakens. By mid-2027, gold reaches roughly $4,300 and ends the year around $4,500, higher than where it began. Gold succeeds because it does not rely on corporate earnings, government finances, or trust in the financial system. It simply holds value when other assets do not. Central banks understand this, which is why they are buying record amounts of gold, around 1,000 tons per year. With countries like China, Russia, India, and Turkey leading the purchases. They are preparing for a world where the dollar is weaker and individuals may want to prepare in similar ways. Behind all of these numbers are real people, and market crashes affect their lives, not just their investment accounts. Someone with $1 million in a retirement plan at the beginning of 2026 could see that balance fall to around $550,000 by mid-2027. A 45% loss wipes out a decade of saving and investing. Retirement may be delayed by many years, or, for some, become impossible. They may have to work for the rest of their lives. The housing market suffers too. Home prices fall 20% to 30%. A house bought for $600,000 in 2024 could only be worth around $420,000 in 2027. If the owners made a small down payment, they now owe more on the mortgage than the home is worth and cannot sell without paying money out of pocket. They are financially trapped. With unemployment around 9%, roughly 15 million people are out of work. Between 8 and 9 million jobs disappear. Recent college graduates struggle to find their first job, and many households face the hardest financial pressure of their lives. The downturn is not just an economic event, it becomes a human crisis. During a major financial downturn, the impact on ordinary people is severe. Many experienced workers in their 50s lose their jobs and are unable to find new positions that pay anywhere close to what they earned before. Families quickly run out of savings and start relying on credit cards, which soon reach their limits. Car loans go unpaid, leading to repossessions. Small businesses struggle as their income drops and the costs rise. Without access to credit, they are forced to shut down, creating even more job losses. Office buildings and retail spaces sit empty as commercial tenants close or move out. Property owners fall behind on their loans, and regional banks that finance these buildings begin to fail. When the government steps in and takes over, deposits are only protected up to $250,000. Businesses with more than that amount in the bank can lose everything above that limit. These losses spread through communities and deepen the damage. The bottom half of Americans by wealth face conditions similar to a depression, while the wealthiest feel the pain but are able to recover. Those at the very top even take advantage of the crisis by buying assets at very low prices, becoming even richer and widening the wealth gap. Rising inequality leads to anger, unrest, and more extreme political views on both sides. Society becomes strained and divided. This is the real human toll of a major crash, and the fear is that it may be approaching. However, there is also a more hopeful possibility. It is possible that the government makes better decisions than expected. Trade policies could be careful and smart instead of overly aggressive. Tax cuts could be matched with responsible spending. Immigration enforcement could be handled in a limited way that doesn't disrupt the workforce. International tensions, especially with China, might remain under control. If economic growth stays strong and the budget deficit improves, financial markets might remain steady. In this more optimistic situation, the stock market could rise. The S&P 500 could reach around 7,500. By the end of 2026, Bitcoin could climb to about $150,000, and gold might remain near $4,000. The economy would grow, companies would earn more money, and the United States would continue to lead the world. The dollar would remain strong, and the national debt would become more manageable. In short, a crisis could be avoided. The chance of this positive outcome is not small, around 35%, but if the negative scenario unfolds instead, the consequences are harsh. The stock market could drop nearly 50%, bringing the S&P 500 down to around 3,400. Bitcoin could lose more than 80% of its value and fall to $19,000. Gold may still rise modestly to $4,500 as a safe asset. Unemployment could reach 9%, and the economy might shrink by 4%. Meanwhile, the value of the dollar could fall by 20%. The contrast between these two potential futures shows what is at stake and why preparing for risk matters. As the national debt grows to around $43 trillion, the amount spent on interest becomes overwhelming, taking up about 30% of all tax revenue. When this happens, the country's credit rating is downgraded, meaning lenders view the United States as a riskier borrower. Over time, America's global influence begins to fade, and the dollar becomes less dominant in international trade. some countries start trading with each other using currencies other than the dollar, reducing its importance. The chance of this situation unfolding is not small, around 25% to 30%. This means it is not a remote or unlikely danger, but a realistic possibility that investors should take seriously. When comparing the best case and worst case outcomes, the risk is not balanced. If everything goes well, stock investors might earn about 13% over a year and a half. But if the crash scenario happens, the losses could be enormous, nearly 50%. Based on simple math, that kind of risk suggests that it is smarter to reduce exposure to the stock market, hold more cash, and increase protection through safer assets like gold. The idea is not to panic, but to protect money, because the potential loss is far greater than the potential gain. This is basic risk management. However, most everyday investors don't take precautionary steps. They fear missing out on rising prices and believe they will be able to sell before the crash. In reality, nobody can predict the exact moment the market turns. When a crash starts, it happens so fast that selling becomes difficult. Prices drop quickly, and buyers disappear. Investors who wait too long end up selling after their portfolios have already fallen by 40% or more, and then they miss the rebound later on. This cycle is why many retail investors repeatedly lose money during major downturns. A smarter strategy is not to guess the perfect peak, but to reduce risk gradually while markets are still strong. This could mean lowering stock holdings from 60% of your portfolio to about 40%, and keeping the extra 20% in cash or short-term treasury bills. Adding 5% to 10% in gold can also provide stability. For people who own Bitcoin, taking some profits now, perhaps selling half or two-thirds, allows them to benefit if the price rises further, while still protecting most of their money if the price crashes. The goal is not to be heroic, but to be smart and cautious. For long-term investors who are emotionally prepared and financially secure, a crash can also create once-in-a-generation buying opportunities. If the S&P 500 drops to around 3,400, it may become historically inexpensive. If Bitcoin falls to around $20,000 and someone truly believes in its long-term success, that could be a chance to buy. But even in those situations, only money that someone can afford to lose should be invested, because prices could drop further and recovery could take many years. The most important priority during major financial uncertainty is simply being able to get through it. Right now, the United States is carrying around $38 trillion in debt and running yearly deficits of roughly $2.4 trillion. The current plan is to raise revenue through tariffs that might bring in about $400 billion, but that amount is nowhere near enough to fix the government's financial gap. Meanwhile, the stock market continues to reach record levels, with the S&P 500 near 6,640, and many analysts predicting even higher levels on the assumption that everything will continue to go right. Bitcoin is close to $100,000, and gold is strong because investors are looking for safety. In other words, financial markets appear to be priced for an ideal world. However, the policies being discussed, including broad tariffs, significant tax cuts, large increases in government borrowing, aggressive immigration actions, and potentially escalating trade conflicts, could slow economic growth while increasing inflation and further expanding the deficit. When markets are priced for perfection but the environment becomes more unstable, the risk of a major correction rises. In the scenario described, the timeline unfolds in stages. Excitement and record highs in early 2026, a correction in the middle of the year, and a sharp market collapse late in 2026. By early 2027, the situation becomes a full-scale crisis, and the lowest point arrives around mid-2027. In that case, the S&P 500 could fall from 7,200 to about 3,400. Bitcoin could drop from 120,000 to around 19,000. The dollar could lose about 20% of its value. Unemployment could reach 9%, and the economy could shrink by roughly 4%. At the same time, national debt could grow to $43 trillion, and the country's global economic influence could weaken. None of this is guaranteed. Policies can change, and decisions made in Washington could shift in a more balanced direction. With careful planning, collaboration, and restraint, the more optimistic outcome is still possible. However, based on current proposals and public statements, there are reasons to be concerned that aggressive economic policies may continue rather than moderate. At the same time, financial markets are acting as though no risk exists at all. The core message is about preparation rather than panic. When markets are priced near perfection during a period of major political and economic uncertainty, the danger is being overexposed just before a downturn. Investors who stay cautious and think ahead are more likely to protect their savings. Investors who assume everything will go perfectly may find themselves facing large losses before they realize what is happening. The goal is not to predict the exact moment a market declines, but to be prepared for the possibility and protect personal finances accordingly.